All right, this video is for Module 31 on the effects of monetary policy. This particular video, we're talking about short-term effects. I want to make that distinction. In the next video, we'll talk about long-term effects. So, first of all, the chain reaction of monetary policy. Monetary policy basically influences the interest rate, which will then influence aggregate demand, which will then pull us into or out of a gap. So changes in monetary policy, like I said, will affect the interest rates, which will change the aggregate demand curve. So if you remember our money market curve, so here's our money market curve, so here's our money supply, here's our money demand curve, and then also here is our aggregate demand or aggregate supply model. So if you will notice, I drew it specifically this way, so I have my aggregate demand curve, my short run aggregate supply curve, and my long run aggregate supply curve. The way I drew this, I drew a gap. What kind of gap is this? Hopefully you said recessionary. The reason it's recessionary is because our short-run equilibrium is to the left of a long-run aggregate supply curve. All right, so let's say that we want to go and fix this. We're using monetary policy. So first thing that we were going to decide is if we're going to use expansionary or contractionary monetary policy. Here's a little trick. It doesn't matter if you're talking about fiscal or monetary policy. Expansionary monetary or fiscal policy will correct a recessionary gap. So in expansionary monetary policy, what we will do is expand the money size. So we're going to increase the money supply. How do we do that? Well, the Fed is going to use one of their three tools. They will use the reserve requirement, they'll use the discount window, or they'll use open market operations. So if they're trying to increase the money supply, if they're using the reserve requirement, what will they do? Hopefully you said they'll lower the reserve requirement, because lowering the reserve requirement means banks have more reserves, they have more to lend out. What will happen to the discount window? Hopefully you said the discount window will drop, because if the discount window drops, that means it's cheaper to borrow money from the Fed. So if it's cheaper to borrow money from the Fed, more banks will do it, so that will increase their reserves. And so therefore they can make out more loans. How about open market operations? What will they do to increase the money supply? Hopefully you said buy Treasury bills. If they buy Treasury bills, that means that the Fed will go and put more money in banks' reserves. They put more money in banks' reserves, that means they have more to lend out, and that increases the money supply. Either way, here's what's going to happen. We're going to go from this lovely green money supply curve to the right to the blue money supply curve, and you'll notice that what happens to my interest rates? My interest rates will drop. So here's my new interest rate. Because interest rates have dropped, what will happen is that it's cheaper to get a loan. If it's cheaper to get a loan, then more people will get loans. So that will increase investment spending as well as consumer spending, individual spending. So we're going to move our aggregate demand curve to the right, because increases in the consumer spending and investment spending, that's part of aggregate demand. It'll move it to the right, and voila, we're back at long-run equilibrium. If we want to go and have contractionary monetary policy will basically flip it and work in reverse. With contractionary, we will have a inflationary gap. I did not draw this. So you would have an inflationary gap over here. You'd want to go and decrease the money supply. So you would either increase the reserve requirement, increase the discount window, or sell Treasury bills, and it would move from this blue line to the green line, which would mean that interest rates would go up. Interest rates go up, and that means that there will be less spending out there. So it would bring our aggregate demand curve from all the way over here, all the way to the left, and that would bring us back to the long-run equilibrium. All right, so that's how it's supposed to work. Reality check here. We have something called the Taylor rule. Okay, the Taylor rule is this idea that the federal funds rate that the Federal Reserve actually sets is going to be according to what inflation has been at in the past, as well as the output gap. Your book goes and gives you a lovely, complicated equation to figure out the Taylor rule. I'm not giving it to you here because personally I don't think it'll show up on your AP test. You just need to know generally how the Taylor rule works. Basically, this is the idea that the Federal Reserve is going to try and figure out, okay, based on what we've been doing so far, inflation maybe has been at this much, so maybe inflation's been at 4%, and our output gap, so remember our output gap could be recessionary or inflationary. Our output gap could be, say, maybe we're short $10 million because we have a recession, okay? The Taylor rule is taking into account that 4% inflation plus the $10 million in the output gap to determine what the federal funds rate should be to be able to correct that recessionary gap. Now, here's the thing. The Taylor rule does use past inflation. So it's this idea of hindsight is always 20/20. It's easy to go back and look and say, oh yeah, inflation was, has been this in the past. A lot harder to make predictions about what it will be in the future. So this is John Taylor, by the way. He was a Stanford economist. He actually did win the Nobel Prize in economics. Yes, there is a Nobel Prize in economics. And this is kind of looking at how the federal funds rate has pretty much been very similar to the Taylor rule. The blue line is the Taylor rule. The red line is the federal funds rate. The exception obviously is here. You'll notice the federal funds rate is actually here, this red line, and the Taylor rule actually has the federal funds rate. They predict that it should have been dropping below 0%. So if you think about it, that would mean, according to the Taylor rule, it would be that the banks would be paying each other to take their money, which makes no sense. It'd be saying that, I'm borrowing money from you and you're going to pay me to do that. That doesn't make any sense. This is what we call the zero bound. We'll get to talking about that a little bit later. But generally speaking, it kind of sort of works. Now, one of the other ways one of the things the Fed does do, they don't really strictly follow the Taylor rule. If it happens to work out that way, great, but they don't strictly follow it. They do what they call inflation targeting, which is basically where the Fed's going to announce what they want the inflation rate to be. Because remember, some inflation is good, shows that our economy is growing. So they will announce and say, we want the inflation rate to be 2%. Okay, so then they will set policies to try and achieve that particular inflation rate. So they will, move around with the federal funds rate trying to increase or decrease the money supply accordingly. So we're trying to target it. So it will look at future inflation. So they're obviously projecting what they want it to be. Obviously, the problem with that is that, like I said, hindsight is 20/20. It's easy to look back and say what it was before. It's a lot harder to kind of move things accordingly to make it where you want it to be. It also makes the actions of the Fed very clear to people. If they announce, hey, we want an inflation rate of 2%, very clear to people what that means. It also makes the Fed responsible for how well they do in meeting that goal. Meaning that if they say that the inflation rate, they want it to be at 2% and it's at 4%, it tells you, yeah, you didn't do a very good job, right? So this is a cute little cartoon. It says, good news, inflation is well above our 2% target in China, India, Egypt, and the UK. Hopefully we will see equally good news in the US stores soon. Meaning that this is the FOMC, the Federal Open Market Committee. So remember, this is part of the Federal Reserve that decides what to do about monetary policy. And obviously this cartoon is saying that they've gotten it everywhere else but the United States, which is obviously not what their intention was. So some argue that inflation targeting is too restrictive because there are times where, for example, maybe we have a recession and we don't want to worry about what the inflation is doing, we want to worry about unemployment. Okay. Some argue that there may be things going on in the economy that we should worry about before we worry about what the inflation targeting should be. Now, keep in mind that monetary policy is the main tool that is used to combat gaps, so inflation or recessionary gaps, simply because of the fact that it has less problems than fiscal policy, but it does have time lags. Because keep in mind that even if the Fed, for example, goes and buys Treasury bills, they put the money into the bank's reserves really quickly. However, it still takes time for people to actually go into the bank, get qualified for a loan, and the bank to go out and give it to them, and then for them to spend it. And so it does have time lags like fiscal policy. It's just not as long as fiscal policy. Fiscal policy, you have all those people in Congress that have to agree, and then it has to be approved by the president, and then monetary policy is usually the first line of defense. Okay. That is the idea about how monetary policy works in the short run. The next video we'll talk about how it works in the long run. Let me know if you have any questions.